All right, guys, welcome back for another video. In today's video, I want to challenge a widely held notion that a rise in interest rates necessarily means a decline in Bitcoin prices. There's a lot of talk recently about Federal Reserve and interest rates, and when people are talking about that, they're talking about the federal funds rate, which is the interest rate that's being discussed at the Federal Reserve meetings. And right now, we're looking at a chart that graphs the federal funds rate charted against the Bitcoin price chart, historical price action. And you can see right off the bat that this notion that a rise in the federal funds rate means a decline in Bitcoin prices is just objectively not true, right? Bitcoin went through one of its most bullish periods ever in its history during a period where interest rate, the federal funds rate, was rising in a steady rate. And not only was it rising, but it was near zero as well, and rose from a near zero environment. And that marked the beginning of a Bitcoin rally. And so this is not to imply that a rise in interest rate necessarily leads to an increase in Bitcoin prices, but I'd just like to challenge the notion that it inherently means the idea that it inherently would lead to a decline in prices. That's just objectively not true. Um, so to put things in perspective, again, revisiting the federal funds rate, it's important to put things in perspective of where the federal funds rate is historically in relation to where it has been previously in history. So right now, we had a 0.25 basis point rise at the last Federal Reserve meeting, and it was previously before that, throughout 2021 at 0.08, which for all intents and purposes is basically 0%, and then it was raised to 0.33. So right now we're at 0.33, um, and you can see here that the rates peaked all the way up at 20% in the early 80s. So it's just important to keep things in perspective like that. When people say interest rates are rising, yes, they are rising, but they're still historically very low. Now, at the FOMC meeting tomorrow, uh, Jerome Powell is expected to put into place a 0.5% rise in the federal funds rate, taking it from 0.33 that it's at now to 0.83. That expectation is very important. If he comes out tomorrow and says it's actually going to be 0.75 point raise, that would be very bearish. The market would react to that. And on the flip side, if he came out and said, just kidding, we're only doing a 0.25% raise, even though interest rates would still be being raised, it's still lower than the expectation that exists in the market. That would be extremely bullish. Now, it's difficult to talk about interest rates without talking about the U.S. equities market. So right now we're looking at a SPY chart, S&P 500, and you can see here that the SPY market, as the U.S. equities, has created a lower low on the weekly and a lower high relative to this high. If you're looking at this trading range, come in, set lower high, run liquidity above these highs, and then run for the lows, take it out on a closing or trading basis, and then closing below these closes here. That I would look at that as a confirmed lower low. Again, this is not a great lower high because it's lower high relative to this, but it is a higher high if you go down to a daily, looking at the daily chart. So it is a higher high relative to this. So this may not be the best lower high, but this isn't a definite lower low, at least on a weekly chart, the way I'd be seeing it. So this is not the most bullish setup, that could exist in any chart, but still, it's difficult to predict, especially on the eve of an FOMC meeting, exactly how the market will react. A lot of times, price will go down and sweep a low like this, run liquidity below these lows, take out the stops below here, liquidate people below here, and then put in a relief rally into some type of retracement. I put a bearish 618 retracement up here, coming around 440 on the S&P 500. Price could rally up to that level, and that wouldn't change anything at all. It wouldn't make the market less bearish or more bullish or anything. It wouldn't. Structure's already broken with the trading below these lows, regardless of if it rallies up into a retracement like this. Now, if these highs were reclaimed, then you're probably in a situation where the market is restoring or resuming a little bit of its, generational trend to the upside. So I would keep an eye out for that. But maybe you do have a hedge in the market. Maybe you hedge yourself somewhere up here, and that's not a terrible position to be in, because there's a lot of uncertainty in the market, and if there's one thing the market hates, it's uncertainty. And you know you can always pull off the hedge if things get back to normal. But we are in a little bit of a deleveraging scenario, so now is not a great time to be having high risk, especially high leverage, because a good portion of the market is being deleveraged in this current environment. So never fun to be part of that group. Now is a good time to be taking risk off the table, not necessarily looking for not necessarily looking for wildly lower prices, right? By reduce risk, I don't mean pile into a short position. I mean reduce risk to both ends. And that means not trying to find bottoms, not trying to look for a bottom, chase a bottom, but just reducing risk if the market gives you the opportunity, and trying to lengthen your time horizon further out and position yourself for, to take advantage of whatever direction the market goes, the next year or 2 years, or whatever you consider that long time frame to be. Also, if we're talking about interest rates, we have to talk about the bond market. A lot of people say that you know the bond market is smarter than the equities market, and tends to be true. A lot of there's just a lot less noise in the bond market, right? So you can see that the bond market has sold off. And what's interesting here is, right, going back to the historical charts, right, interest rates have not risen, materially, right? I mean, in a historical context, that you have this little blip down here, and meanwhile, the bond market is selling off pretty incredibly. And so it's a selling off on the expectation of future interest rate hikes. That's very important, right? So the interest rate hikes that are predicted, the 9 or so interest rate hikes that are predicted, that the Fed has signaled that they would likely do, they are being priced into the market currently. And that's a very important distinction, because oftentimes you'll see that, like previously in the last FOMC meeting, right, there was a 0.25 interest rate hike predicted, and the market rallied off that news when it actually came to pass. So we can see it very clearly on the Bitcoin chart. Uh, and again, the credit markets, interest rate, they tie into every market. Bitcoin is unfortunately tethered to that market, so it'll be reflected in that chart. But you can see here, your top right here, and really all-time high in Bitcoin. This was in the November FOMC meeting. That was when Jerome Powell started talking about raising interest rates. Price makes one last push to grab liquidity, and then aggressively runs down. And this trend right here is the market pricing in the expectation of future interest rate hikes. So we didn't, going back to the federal funds rate, right, during that whole period, that 50% correction in Bitcoin, that was all from talk, right? Interest rates hadn't actually rose. They were still at 0.08% the whole way down from 69,000 to 33,000. And it wasn't until the March 16th FOMC meeting that interest rates actually rose. And what do you see? When the date when interest rates actually rose and the expectation of the market was met, even though it was a rise in interest rates, a lot of times the resolution of that uncertainty about the possibility of something unpredictable happening being resolved, that uncertainty is resolved, and the market rallies off that news. And now we have a full retrace into essentially what is the same area, basically, as the March FOMC meeting. So, that's a scenario where, if the Federal Reserve comes out and there's no surprises tomorrow, and they just announce a 0.5% interest rate rise as planned, as predicted, Bitcoin sitting at a lows. It came out, set higher highs, retraced the full swing. It's at the lows. You probably see a little bit of a relief rally. Does that relief rally mean anything in the context of the greater picture? Probably not. But it's just a typical pattern that plays out in the market, right? You relieve that uncertainty, the market feels a sense of relief, it rallies off that news. The rally doesn't mean anything, but it is something to keep in mind and pay attention to. As we were talking about before, now is a good time in the market to be taking off risk, to be taking off leverage, to be trading with less risk, especially tomorrow, right? You have the FOMC meeting tomorrow. That's a very important data release to keep an eye on. Probably not a good idea to stand on the train tracks before the data release hits the markets. Probably a better idea to, just be patient, hang back, see what the news brings, and just have your trading fall in line with whatever direction the market goes from there.